Welcome back to CEO Money. I'm Michael Yorba, your host. Thanks for joining us. All right, in studio, flew in just from Nashville on his whirlwind tour, Michael Markowski, CEO, financial analyst, Dynasty Wealth. Welcome to the show, Michael.
Hey, good to be here, Mike.
I'm glad you flew in. We got a lot of things to talk about, but let the listening audience know you're going to do another video with us right after the show when we run over to the TV studio, right?
Yeah. Sure. I'm in just in town for to shoot a video. We got a lot of subjects we're going to cover pertaining to the bear market and how to trade it and crash investing. And people shouldn't be afraid of volatility and crashes. Just be prepared, and if you're educated, you can make money. They're redistribution of wealth is what it's all about.
Everybody's on right on the tip of their tongue. Tell me how.
Say what?
Tell me how. You can make money in a bear market. Tell me how. I mean, do you have a 90-10 process? We can go into that. Or do you want to start with, here's what's going on now with the market, here's where we see it's ending up, and here's the causes for what we are soon to experience?
Yeah, well, we're going to, and just to brief, we're going to have this video, and we're going to explain how the perfect shorts, in a bull market, there are companies that emerge what I call perfect shorts.
I want to hear this.
And those are companies that don't have business models that can sustain themselves in a marketplace where capital is not available. So
like Tesla?
Market. What?
Like Tesla?
Well, yeah, Tesla is one of them, as we've talked before in the past. But Lehman, Bear Stearns, Merrill Lynch all had unsustainable models. And people ask me why. They were brokerage firms. How did all of a sudden Lehman go out of business after being in business 100 years and or so? And I said it's because they changed their model. When the dot-com bubble burst, they changed their model from being a broker-dealer to being a subprime mortgage underwriter. And basically, they went from underwriting stocks to underwriting subprime mortgages. They ate everything. They didn't resell the stuff, and that's what happened with all those broker dealers. So they changed their business models to basically they couldn't go forward with those business models. That's why they were all perfect shorts. Okay,
right. Well, give me another perfect short.
Well, I had one other one called Astro Power, which is
I was wondering about Facebook.
Facebook's not. Facebook's not.
No.
Facebook. So this is one of the things we're going to go over the show. These are specific animals, and your listeners should become viewers and watch the video once it's available, and we'll have it here on the website.
All right,
WFN1.
I won't goad you any more of that. All right. I know that you came in here with a full head of steam. You wanted to talk about a secular bear market and the tariffs. You had mentioned that before. Yeah. So go ahead and lead us through take us down the merry path.
Well, I think again, hate to be the pitch master here, but we did that. We shot that video, and anybody who's listening to this show today should go to the website and watch the video between Michael and I, the last interview we did. And in that video, I talked about the tariffs, and I talked about the fact that based upon my research, the Smoot-Hawley tariff caused the crash of 1929 and the Great Depression. And why is that important? Why is that significant? Because the Smoot-Hawley tariff was not enacted until 1930. So
let's tell them where to watch the videos at WFN1.tv, right in the middle at the very top. Then you can see all the videos he's talking about. Please go on with the tariffs.
Okay. So what happened was how the heck can a tariff that was enacted in June of 1930 cause a crash of October 1929? It's a fascinating story, and it was I had to do a lot of sleuthing work to figure this thing out. I'm writing a report on it, but it's on the video how it happened. But let's not get into that.
Right.
The key is that the tariff. Why is the tariff? Everybody says to me, I talk to people, well, we're going to basically change our trade balance, okay? So it's almost like people are like, well, maybe they're buying into this thing that Trump is saying. And I'm saying, no. Here's the problem that a tariff causes for a stock market. And let's go back to the secular bull, which began in 1982, bull market, and ended in 2000. That was the 18-year bull. That was the longest bull of any bull in over the last 100 years by far. Okay, 18-year bull. Why was that an 18-year-old bull? Because what happened, it started in 1982. By 1988, 89, the world changed, and that bull should have become a bear. That's the average bull or bear is about 8 years.
Right.
Like this one's about 9 right now, 8, 9, 10 years.
Yep.
It should have ended in 1989, okay, that bull market, or 1990. But it didn't because of two things. The Berlin Wall fell, okay, and the whole
International commerce.
right. So communism was broken,
Right.
okay, in 1989 or whatever it was, and at the same time, China liberalized its economy at the same time. So what you had is that why you had the longest bull market is now you had a global economy. Now with that coming in, that took the time span and that gave that bull the energy to stay alive until 2000. Another 10 years.
We only have a couple of minutes. What about now?
Okay, now, the problem is that works in reverse. So the key is PE multiples go up when you have unlimited growth. When you have global trade restrictions, PE multiples have to come down. And that's what the analysts don't understand. There are all these financial experts and all this stuff. PE multiples have to be compressed when China is basically tariffing our products and we're tariffing 1,100 of their products, and all this stuff is causing all this. So PE multiples have to come down. That's what the problem with the tariff is.
Is that why Caterpillar is getting its head handed to them and other industrial
stocks?
Stocks
That's why Boeing and Caterpillar are both getting their heads handed to them, and they're not going. Boeing and Caterpillar will not eclipse their highs of this year for 10 years.
According to your opinion. No, you can't guarantee this stuff.
For 10 years.
Okay. So are you saying that the mainstay of American international businesses are going to have a big problem going forward, and that's going to lead us into a bear market that could last for how long?
I think the bear market could last at least 10 years, yeah.
With how big of a drop before we hit the music?
I'm looking for, from peak to trough, about 65, 70%. So I'm looking for the S&P to go to 1,000. I'm looking for the Dow to go to around 1,000, somewhere in the 12,000 area on the Dow, S&P around 1,000, that area.
Okay, we got to sign off for now, but if you want to know any more, WFN1.com. We're going to run over to the studio right after we finish this show and put up that new video as soon as we can. Give us a day to render it, but we're going to go right to the television with this. We'll be right back tomorrow with more great content. Thanks for listening. It's CEO Money. You've been listening to, but don't forget WFN1.com and WFN1.tv to see this video we're talking about on this segment right now. Thanks for listening.